So we are studying the convergence of sequencing and artificial intelligence and CRISPR gene editing. We're seeing all kinds of platforms converge here, but this is probably one of the most important set of convergences. Is it wild-eyed to be thinking that as this convergence evolves and we get deeper and deeper into understanding what's going on, that we could cure most diseases? Is that outrageous to think? Or I'm just dreaming? I realize it's not 50, it's 15, 20 maybe, a long time away, but is it a crazy thought?
Welcome back to the Stock Estate, everyone, and in today's stock market show, the theme will be on long-term investments. Recently, ARK has been buying $10 million worth of shares of this company in their ARKG fund over the past week. And in this video, I will give you my research as well as my personal insights. At the end of the video, I will give you my thoughts on which kind of investors should buy this stock. So stick around to the end of the show. I think you'll like it. The company we will be talking about today can be described in one sentence. A top dog company with reasonable valuations and a chance at high growth factor along with the industry. It kind of reminds me of the ramen I eat today, with a strong miso taste and a tad little bit too salty. I digress. Hope you're enjoying today's stock therapy session with me, and put it on 1.5 speed if you're impatient just like me, and smash the thumbs up button because it really helps this new channel out in a very, very, very big way. And consider subscribing to my channel, where my goal now as a next financial advisor is to help you become a better investor and plan ahead by sharing my long-term investments, research, as well as my trade plans. Remember in my last video, I mentioned that I was going big on genomics, and this company is in the genomic space. So this company is none other than Roche. R-O-C-H-E, ticker symbol RHHBY. And the table of contents today will be what it does, why is it a top dog, what kind of valuations is it, the potential for its sector growth, as well as the last part is who should be buying this stock. I always emphasize as a financial advisor that every single one is really, really different. Every single one's portfolio is different. Risk factor is also different. Hence, you should not just be buying all the cookie cutter stocks that's out there people are recommending, because you are different. Only you know what kind of investments are best suited for your own good. And let's jump straight into it. So again, one phrase to describe this company. It's a top dog company with good valuations and a sector growth opportunity. So what does Roche does? Roche is headquartered in Basel, Switzerland, and Roche is a leader in research-focused healthcare. With combined strengths in pharmaceuticals and diagnostics. We jump over to their website over here. You can see that they have their products are pharmaceuticals as well as solutions for diagnostics, as well as a small segment for personalized healthcare. You just jump into pharmaceuticals, you can see that they actually have a tons of medicines out there for the masses. And it's really a huge company. It's also a world leader in vitro diagnostics and tissue-based cancer diagnostics. Which, if you watch my previous video on genomics, currently cancer is one of the most important advancements that has been made in the cancer field in terms of genomics. So I would say cancer is one of the areas where genomics really have currently shown through, and in other aspects of diseases wise, not so much yet, which still have many areas for growth. And founded in 1896, Roche has been making a lot of contributions to global health. They developed 24 medicines, which is included in the WHO model list of essential medicines. So we can see that this company is massive. It's really massive. He has differentiated medicines in oncology, immunology, infectious diseases, and many more. You can see that they're not just in Switzerland. They are headquartered in Switzerland. They have branches in Germany, Shanghai, Japan, as well as San Francisco, CA, and many other places. So roughly know what this company actually does. And what is the most interesting factor right here is you can see that it is actually the top pharma company by oncology sales, which is cancer. Okay, so it's the top dog over here. Okay, way eclipsing the second place. Okay, times 2 the amount of revenue and sales compared to its competitors. Okay, so first place is Roche, second is Celine Corp, then is Novartis, then is Bristol Myers Squibb Co. Okay, and you can see that they are the top company in terms of cancer, which is one of their best-selling products. And you can see that by market cap, right, only Johnson & Johnson is bigger than Roche. Okay, Roche is the second biggest market cap, okay, in the biotech space itself. So you can see that what you're buying into, okay, is a very big company. Okay, you can think of it akin to a bit like Amazon, okay, because it's a really huge company. Okay, you can see that it is really the cumulative, of the entire number one player in this entire space. Okay, and what is the rule that I have? Okay, the rule that I have as an ex-financial advisor is that when we are going for high growth in a growing sector like genomics, okay, most of the time the most steady and surefire growth will be from the number one player, which will capture the fair share of their market. Okay, sure, the small cap companies can have massive gains, but those are harder to predict, and there's a lot of risk factors. Okay, so you can see that this guy is the top dog. Okay, it's the top dog. Okay, I can see akin to a little bit like Amazon. Okay, in their e-commerce space. Okay, it has branches everywhere. Okay, and it's a very huge company itself. And you can see that in ARK Invest, right? Its thematic elements in ARK Invest. There's molecular diagnostic, beyond DNA, gene therapy, instrumentation, bioinformatics, targeted therapeutics, next generation oncology, agricultural biology, as well as stem cells. Okay, I would say Roche covers molecular diagnostics, okay, gene therapy, bioinformatics, okay, a little bit of stem cell in its R&D, as well as its next generation oncology. So you can see that they have many branches, which actually spreads out into a lot of the things that ARK Invest is actually looking for. Okay, and now, okay, we look at its valuations, okay, or what is it makes it so valuable, okay, and what justifies its current valuations. Okay, so let's look at the numbers itself, okay, the most important part, okay, of every single company, okay, the part where it's the most boring, okay, but I'm willing to do the hard work for you, okay, I'm gonna just break it down into simple terms for you, okay. So you can see right here, right, okay, that this company right here, he has a lot of assets, okay, current liabilities, assets. You can see that its total assets is $814,000, okay, in 2018. Then after 2019 is $703,000, okay, and you can see that its total liabilities are much lesser, okay, less than half, and again $357,000, less than half, okay, and its total stockholders' equity is also hugely positive, okay, $496,000 as well as $346,000. Okay, so whenever the shareholders' equity is a positive, that means it's normally a good thing because the assets are more than its liabilities, and that should be quite straightforward. Okay, it's quite a brain dead question. Okay, so that means they have much more assets they can liquidate, okay, to pay off any liabilities that they have. So in this aspect, okay, I'll say that it's a healthy balance sheet for their company. Okay, second one, we're gonna talk about its sales. Okay, its sales itself. So contract revenue, okay, you can see the 2018, 2019, okay, they have year-over-year growth in sales. Pretty good actually, year-over-year growth in total revenues, increasing total revenues. But however, you can see that currently, right, although they have increasing contract revenues and total revenues itself, okay, growing quite steadily, and a lot of sales has been coming in over the years, but however, you can see that suddenly, oh my god, you expect that the total net loss, right, will be lesser, right? Okay, but however, the net loss increased so much to $185,000 last year itself. So you must question yourself, okay, so what did this come from? Okay, if it comes from bottom line, okay, that means they are spending a lot of money on costs that are not instrumental to their business, then there's a cause to be worried about. But however, if you look at where are they spending all their $191,000 on 2019, is actually a lot on the research and development costs, okay? That's where it actually instrumentally or incrementally increased by a massive amount. You can see from here, 2019 here to 2019 here, they have increased so much of their research and development. Okay, so I'm not too worried because in this kind of biotech companies, I'll be worried actually if they don't spend money to innovate. Okay, and they do have a healthy amount of cash, so I'm not too worried about this spending. Okay, so I would say that healthy revenues. Okay, as you can see that they are the top sales, bring in the top sales in oncology. Okay, very solid company, which is very normal for them to spend a lot on R&D to bring in future revenue, because if they don't innovate, then they are set to fail. And speaking of innovation, okay, I really like the CEO itself, Severin Schwan. Okay, pardon me if I didn't pronounce his name properly, but he's the CEO of Roche. Okay, what I like about this guy, okay, he's the CEO of the Roche Group. He joined in 1993 as a trainee and has stayed with the company ever since. Okay, and he climbed all the way from here to become the chief executive officer. Damn, what a story. Okay, what a story. Okay, let's talk about his valuations. Okay, so his market cap is currently $290 billion. Okay, huge market cap. Okay, and his trailing PE is 20. Forward PE is 13, very nice. Okay, so when I'm looking at this kind of huge market cap, right, with huge numbers in, right, okay, I'm looking for the forward PE for anything lesser than 20. Okay, anything less than 20, I would say is a generally quite healthy PE. Okay, and normally, for these kind of big companies, right, it's like Amazon, right, like Amazon, Facebook, you normally be paying a little bit of a premium on this kind of companies. But however, 13.91 is a very reasonable PE ratio. Okay, price to sales even better. Okay, price to sales I normally look for around 5 to 10. Okay, lower than 10. Okay, lower than 5 is the best. Okay, lower than 10 is okay. So you can see 4.34. Okay. Their price to sales are insanely cheap. Okay, so it's a very reasonable valuation. So I'm really liking what I'm seeing on the valuation aspect. Okay, and yes, lastly, okay, potential for sector growth. Okay, this part I'm not gonna go deeper into it. Okay, if you wish to know about why I think this sector will actually grow a lot, okay, you look at my previous video, which is also on my video on my homepage. So no worries about that. Okay, go check it out. Okay, but this sector itself, genomic sector, okay, huge potential for growth, which I can see the entire market cap of this entire sector, right, 5 to 10x in the next 5 to 10 years, easily. Okay, easily, I think easily 2x by next year. Okay, insane. Okay, it's a turning point now. Okay, and a little bit more of a push over the edge, and they will actually explode in growth. Okay, and lastly, okay, I'm going to talk about who should actually get this kind of company. Okay, so for my portfolio, I actually never really talk about how I structure my portfolio. So this is how I do it. Okay, 20% will be on liquid cash. Okay, this is what I have, just in case for emergencies. Okay, it's something I put in my checking account. So it's not being touched. It's just there. Okay, then this is actually used for emergencies, or if there's any huge crashes. Okay, I can take advantage of any good dips in any of those long-term investments that I want to. Okay, massive dips like 20-30%. I can actually use this liquid cash to average down for a cheaper price. Okay, so always my rule is at least 20% liquid cash. Okay, so just in case, so you don't have to sell your investments for anything. Okay, and 10% will be for swing trades. As you know, a lot of my past contents about swing trades. Okay, so swing trades actually is only 10%. Okay, 10% I'll be swinging in and out. Any profits I'll be putting into my long-term investments. Okay, and swing trading, not always the full 10% will be inside, swing trading. Sometimes I'll just be using a little bit. Just 10% I'm allocating to swing trading. Okay, and I always be looking for the next big thing to swing trade my profits and compound my profits. Okay. Lastly, okay, 70% will be for here and here. Okay, is for my long-term investments. Okay, it's split into 40% safe and 30% spaq. Okay, so what does it mean by spaq and safe? Okay, safe means very low chance of bankruptcy, or very low chance that I will lose all the money for my investments, or I have a certain guarantee that it will continue to make revenue over the next 5 to 10 years, and although it might not grow as much, okay, it will be a very solid investment that will give me generally decent returns over the years. Alright, and ETFs also generally fall into this segment, because ETFs are a basket of companies, so they are normally more safe, and we don't have to look into it. There's unlikely that all the entire ETF will fail, so it will be generally in my safe investments. And spaq plays. Okay, spaq plays are more speculative as well, because so for the next 5 to 10 years, okay, there is a small chance that they might not be able to turn a profit, and they will not be profitable for the next few years, and these are counted as spaq plays, because if they're not profitable, there's a chance. Okay, no matter how you look at it, there's a chance of them going bankrupt, or there's a chance of them not being able to turn profit and just stagnate, their stock price just stagnate that all the way. Okay, but these are also companies which are in good industries and have a chance for huge growth in the future, where I can see it, as a small market cap, it can actually explode up to a huge market cap, 10x, 20x my gains. Okay, so it's more speculative and more, I would say, a little more dangerous. Okay, so this is how I actually structure my entire portfolio, and Roche will actually go into my safe investments actually, because Roche is such a solid company, huge market cap, very good sales, reasonable valuations. I can see it earning money, in the next few years, okay, and turning a profit. So it will be belonging in the safe investment. So investors who are, overexposed in the spec plays, okay, I would consider, you adding a little bit more safe investments like Roche into your portfolio. If you're overexposed in safe investments and not a lot in spec plays or high growth companies, then maybe you should look at other smaller cap companies which can, in the genomic space, which can actually give you a much higher return than Roche. Because Roche, I would say, I won't expect it to have huge, massive growth, because to double a market cap of $280 billion, honestly a little bit difficult. So, but I would expect, a decent growth year after year, 20% per year, pretty decent. Okay, and yeah, that's what you have to do. Okay, do not overexpose yourself too much of one sector, because you'll be doomed for failure because you don't plan. And yeah, that's it. Okay, and I have to say it. Okay, and please do your own due diligence. Okay, and also make decisions for yourself. Okay, only you know your portfolio the best, and I hope to be a guide or an aid to help you on your investment journey. Okay, I really hope you guys enjoyed the video. I hope you guys have a really nice day today. Okay, drink some coffee, have some beer. Okay, have a good night today, and thank you for watching the Stock Estate Show, and I shall see you in the next video. Okay, smash the like button and subscribe for more videos like this. Stock Estate out.